$4,081 per ounce. That was the number. A new all-time high for gold. Less than 24 hours later, it collapsed 5.5%. The largest single-day drop since August 2020. Silver crashed even harder, down 7.6%. This isn't a pullback. This isn't healthy consolidation. This is panic. This isn't what Wall Street told you. Mainstream headlines rushed to explain. Reuters called it profit-taking, a simple case of investors cashing out after a big run-up. Kitco Metals said volatility spooked short-term traders. The narrative was clean. Gold went up too fast. Now it's cooling off. Nothing to see here. Before we start, like and subscribe, because there are things here that you need to know before anyone else. But if that's all it is, then explain this. Why did the US dollar jump 0.4% at the exact same time? Why did the Dow Jones drop over 300 points? Why didn't central banks, who've been buying gold all year, step in to support the price? Something else was at play, something they're not telling you. The crash happened on the same day Donald Trump confirmed a meeting with Chinese President Xi Jinping. The two are set to meet in South Korea next week. No public agenda, no press conference. But the timing is no accident. Behind the scenes, US-China relations are shifting again, not just on tariffs, but on something deeper. Rare earth minerals, supply chains, and most of all, currency reserves. At the same time, another piece of news slid under the radar. The US inflation report, originally scheduled for release, was postponed. Reason: government shutdown. That delay might seem bureaucratic. It's not. It's a signal. Because without official inflation data, the Fed doesn't have a clear picture. The market doesn't either. It's like flying blind in a storm. And in that storm, capital doesn't behave rationally. It runs to the strongest signal. In this case, it ran to the dollar, not gold. That's the paradox. Gold is supposed to be the safe haven. But when liquidity dries up, it becomes the first thing sold. This wasn't just fear. This was strategy. Here's how it works. Imagine you're a macro fund manager. You borrow in yen at 0% interest. You use that cash to buy gold, betting on inflation, betting on rate cuts, betting on chaos. But suddenly the dollar strengthens. That makes your gold holdings more expensive to hold. Your profit disappears. Your leverage bites. You start selling. Now imagine 50 funds doing the same thing. Add margin calls. Add algorithms. Add momentum traders. It spirals. That's what we saw. Forced liquidation across the board. The chain reaction wasn't limited to gold. Silver fell almost 8%. Platinum, palladium, copper, all down hard. The Dow fell 301 points. Bond yields moved. The VIX spiked. Liquidity vanished. This is what happens when a safe asset becomes a crowded trade. Everyone's in. Nobody's hedged. And one external shock triggers a rush for the exit. But what was the real shock? Not the price action, not the charts. It was the silence, the blackout. No inflation data, no guidance from the Fed, no visibility. And on top of that, Trump's announcement of the China summit. Let me ask you this. When was the last time a US inflation report was postponed? When was the last time gold dropped 5.5% on the same day the dollar surged? When was the last time both happened while geopolitical tensions were rising? That's not coincidence. That's coordination. This crash wasn't about traders taking profits. It was about major players repositioning before something bigger. We're talking about structural capital shifts, out of speculative assets into hard currency, out of emotion into discipline. Gold didn't fall because it was weak. It fell because it was strong and crowded. And while retail investors panicked, the smart money was watching something else entirely. The alignment of diplomatic moves, macroeconomic silence, and market dislocation. The kind of environment that precedes monetary realignment. If you think this is about day-to-day price action, you're missing the forest for the trees. Trump's meeting with Xi won't be about peace. It'll be about positioning. China's been dumping treasuries, buying gold, tightening control of rare earths. They're preparing for a future where the dollar isn't the center of the system. Meanwhile, the US is shutting down data. delaying CPI, leaving the market blind. That's not by accident. It's part of a wider game, and gold is the scoreboard. If you're only watching charts, you're too late. The real game is being played in silence. We don't bet. We anticipate the sell-off was brutal, but that was just the surface. The deeper story is not who sold, but who kept buying. Gold is up 60% in 2025. It didn't happen by accident. It didn't happen because traders on Reddit got excited. It happened because the biggest players in the world, central banks, were moving quietly, consistently, and deliberately. Not hedge funds, not ETFs, not Wall Street, China, India, Russia, governments and central banks, not traders. They weren't buying gold for yield. Gold doesn't pay dividends. They weren't chasing momentum. Central banks don't swing trade. They were accumulating it like a nation preparing for impact. Silent stockpiles, weekly bids, strategic buildup. While the West debated interest rates, the East bought gold like the system was on borrowed time. This isn't what Wall Street told you. Bloomberg said the gold rally was based on rate cut expectations. Citi said once the shutdown ends and a few trade agreements are signed, the market would stabilize. That's the line. Wait it out. Things go back to normal. But that's not how real power operates. Central banks don't buy gold to time markets. They buy it to prepare for stress, deep systemic stress. They see what's coming before the rest of us do. They see currency risk. They see sanctions. They see fragmentation. They don't react. They insulate. Buying gold is the monetary equivalent of building a bunker. And they've been building since 2018. Look at the data. China's official gold reserves have surged, but unofficially, the number's likely much higher. Russia has been offloading dollars and increasing its gold to GDP ratio. India, Turkey, Brazil all buying. Not ETFs, not options. Physical metal vaulted unleveraged. The West says it's just diversification. The East says nothing at all. But the volume speaks. What are they preparing for? While the US focuses on rate paths and CPI, the rest of the world is building insurance against something bigger, the potential unraveling of the dollar-based system. Not tomorrow, but maybe soon. And definitely not by surprise. You think the Trump-Xi meeting is about tariffs? Think again. It's about architecture, monetary architecture, SWIFT versus BRICS, dollar versus gold. Control versus credibility. The old system is too centralized, too politicized, too weaponized. Countries are finding alternatives that don't depend on the Fed, the Treasury, or Washington's approval. BRICS nations are already talking about a gold-backed currency bloc. It's not official, but they're moving in that direction. Slowly, carefully, but deliberately. Trade deals are being settled in yuan, rupees, and rubles. Bilateral swaps are replacing dollar settlements. And in the middle of all this, gold is being hoarded, quietly. If you want to understand what's happening, don't look at price charts. Look at stockpiles, gold reserves, vault flows. That's where the real story is. When a central bank buys gold, it removes liquidity from the market. That's deflationary. It strengthens their monetary base without relying on foreign debt. It signals distrust in fiat stability. It's like a manufacturing company buying steel before a conflict. They're not saying war is coming, but they're acting like it is. You don't always see the crisis, but you see the preparation. This changes the entire equation. Because if gold becomes the neutral reserve of choice, the dollar doesn't just lose market share. It loses leverage. Sanctions become weaker. Trade blocs become stronger. Inflation, once dictated by domestic policy, becomes partially dictated by external gold flows. In that world, gold is no longer just a commodity. It becomes a monetary base, a settlement tool, a trust anchor. That's what this accumulation means. And if you think that's far-fetched, ask yourself, why are so many countries choosing gold when they could buy bonds, equities, or even crypto? Why physical metal? Why now? Why so quietly? Because this isn't about return. It's about protection. This isn't trading. This is monetary defense. The market hasn't priced this in. The average investor hasn't seen it coming. But the movement is there. You don't need a theory. You just need to follow the flows, and the flows are going into vaults. This impacts everything. The dollar's value won't crash overnight, but its supremacy erodes over time. Slowly at first, then structurally. As more trade settles outside the dollar, demand drops. As more gold is accumulated, alternative confidence rises. It's like the early stages of a currency divorce. Still civil, but the papers are being drawn up. In a system where gold is being recast as the final settlement layer, it creates a new dynamic. It puts pressure on central banks that don't hold enough. It exposes debt-heavy nations. It creates friction in trade policies. And it increases volatility, because every financial model built on dollar dominance starts to wobble, and you, as an investor, as a citizen, as someone trying to protect value, are left in the dark. Wall Street won't tell you this. Not yet. They're still stuck in quarterly earnings, ETF flows, and Fed signals. But that's not where this story is heading. This is about intent, not price. Gold at 4,300 is a data point. But 60% gains in 1 year, led by central banks? That's a declaration. They see what's coming, and if you're not paying attention, you'll only understand when it's too late. This isn't fear. This is pattern recognition. When systems prepare quietly but in sync, it means they expect impact. Not maybe, not possibly, definitely they don't bet. They anticipate, and so should you. If you've made it this far, leave a like and subscribe, because news like this, you should be the first to know.